Hi, everyone, and welcome back to Smart Money with Diana. In today's lesson, we're going to take something that sounds scary, loan amortization and monthly payments, and make it super easy to understand. By the end of this video, you'll know what a loan amortization is, how monthly payments are calculated, how payment timing, beginning or end of month, affects the result. Let's break it down in the simplest way possible. What is amortization? Imagine you borrow money from a friend. Instead of paying it back all at once, you give them a little bit every month. Some of it goes to reduce what you owe, the loan, and some of it goes to say thank you, the interest. That's basically amortization. A loan paid in small, equal chunks over time. Each payment equals principal, what you borrowed, plus interest, extra cost of borrowing. Let's introduce the monthly payment formula. PMT equals I times P over 1 minus 1 plus I 2 minus N, where PMT equals monthly payment. P equals loan amount, principal. I equals monthly interest rate, annual rate divided 12. N equals total number of payments, loan term in months. This formula assumes payments at the end of each month, most common case. Example 1, payment at end of month. You borrow $10,000 at 6% annual interest for 3 years, payments at the end of each month. Step-by-step breakdown, P equals 10,000, I equals 0.06 divided by 12 equals 0.005, N equals 3 years times 12 equals 36 months. PMT equals 0.005 times 10,000 divided by 1 minus 1 plus 0.005 to divide by 36. PMT equals 0.005 times 10,000 divided by 1 minus 1.005 to divide by negative 36. PMT equals 50 divided by 1 minus 0.835645. PMT equals 50 divided by 0.164355 PMT equals $304.15. You pay $304.15 every month. Example 2. Payment at beginning of month. Now, what if you pay at the beginning of each month? In that case, we need to adjust the formula for an annuity due. The base formula remains the same, but the result is multiplied by 1 plus I. PMT begin equals PMT end times 1 plus I. Using our earlier result, PMT begin equals 304.15 times 1.005 equals $305.67. PMT end equals $305.67. Why? Because when you pay earlier, each payment reduces interest a little faster. That means your loan is repaid slightly sooner, but monthly payments are just a bit higher. When is this used? Rent payments, typically paid at the start of the month. Insurance premiums, leasing contracts. When do you pay at the end? Most personal loans and mortgages, credit cards, auto financing in many cases. Paying at the beginning means you owe for fewer days each period. That's why interest is slightly lower overall. Comparing both scenarios. End-of-month payment. You will have a monthly payment of $304.15. And your total paid over 3 years will be $10,949.40. Beginning of month. You will have a monthly payment of facilitates $305.60. Your total paid over 3 years will be $11,004.12. A tiny change in timing affects your total cost. Real-life applications. You'll find amortization schedules used in mortgage payments, usually end of month, rent payments, usually beginning of month, car loans, personal or business loans, These tools help you plan your budget and see exactly how your payments reduce debt. That's it. Now you know how monthly payments work and how timing affects interest. In the next episode, we'll build an amortization table step by step, and you'll learn to calculate your own payment breakdown. Make sure to subscribe and hit the bell so you don't miss it.